As we head into the new trading week, the U.S. markets are, of course, closed for the weekend. The story for Opendoor Technologies, ticker OPEN, is all about the battlefield that was Friday's session. The stock officially closed Friday, November 7th, 2025, at $6.56 per share. But that closing number tells you almost nothing about the sheer chaos of the day. This wasn't a calm day. It was an intraday war. After releasing its third-quarter earnings on Thursday evening, the stock was pummeled in after-hours trading, and on Friday morning, it gapped down hard, opening at just $5.33. Anyone looking at the pre-market would have assumed a total collapse. And yet, from that $5.33 open, the stock staged a violent intraday rally, soaring more than 23% from its low to close back at $6.56. This wasn't a drift. It was a verdict. The market digested the bad news, spat it out, and then found something else to chew on. The expectation, the narrative that drove that gap down was perfectly clear. On Thursday night, the Q3 2025 numbers looked, on the surface, like a confirmation of the bear thesis. The company reported a loss of 12 cents per share, which was a significant miss from the 7-cent loss analysts had forecasted. Revenue came in at $915 million, which also missed the $922 million consensus estimate. The net loss widened to $90 million, which is worse than the $78 million loss they posted in the same quarter last year. Perhaps most troubling for a business built on spreads, the gross profit fell to $66 million, down from $105 million a year ago. And the all-important contribution margin, the profit they make per transaction, was squeezed down to just 2.2%. That's a razor-thin margin and a sharp drop from the 3.8% they had in Q3 2024. In this high-interest rate environment, where the housing market is essentially frozen, these numbers look like a fatal blow. The iBuying model, which relies on a high volume of transactions and stable home prices, is supposed to be broken, and these earnings seem to be the proof. But the reality, the story that drove that 23% intraday reversal, is completely different. It seems the market isn't looking at the past. It's looking at the pivot. The real story wasn't the Q3 numbers, which reflect acquisitions and decisions made months ago in a difficult market. The real story is the new leadership and the Opendoor 2.0 plan laid out by the new CEO, Kaz Nejatian. The company essentially drew a line in the sand. They are no longer just trying to survive. They have laid out a concrete, measurable path to profitability. The new North Star for the company is to achieve adjusted net income breakeven by the end of 2026. This wasn't just a vague promise. They announced a new public dashboard at https://www.google.com/search/q=accountable.opendoor.com to weekly track their progress on home acquisition contracts. This is a massive shift in transparency, an attempt to rebuild trust with investors who have been burned by this stock before. It's a bold move, and it seems the market is willing to give them a chance. This new plan is aggressive. The guidance for the fourth quarter is where the expectation versus reality split becomes obvious. While Q3 was bad, the company is guiding for Q4 acquisitions to increase by at least 35% compared to Q3. They are not retreating. They are stepping on the gas. They are betting on their new, supposedly superior AI-driven pricing models can accurately buy homes even in this volatile market. This is the core of the bull thesis, that Opendoor has built a better pricing algorithm than anyone else. This is combined with a ruthless focus on expenses and operational leverage. The trade-off, however, is that revenue in Q4 is expected to decrease by about 35% quarter over quarter. This isn't a contradiction, it's a reflection of the past. Because they bought so few homes in Q3, down 67% year over year, they simply have less inventory on the books to sell in Q4. This is the last bit of the poison working its way out of the system. The Q4 loss is expected to widen, with adjusted EBITDA loss projected in the high $40 million to mid $50 million range, but the market on Friday seemed to say, we don't care about Q4's loss. We care about the 2026 break-even target. This kind of volatility is exactly why so many people are hesitant to dive into self-investing with single stocks. A name like Open is a pure story stock right now, not a fundamentals play. Its daily swings are more dramatic than even Tesla stock or some of the moves we've seen in Nvidia stock. It's a world away from the relative stability of a giant like Apple stock. Many people trying to navigate this look for investment help or opt for automated systems like Schwab Intelligent Portfolios. The strategy for this stock is completely different depending on your platform. If you're on the Robinhood app, you might be tempted by the Robinhood stock trading aspect, trying to catch these 20% swings. But a long-term investor using an individual brokerage account at Fidelity is asking a different question. They're looking at Fidelity Investments and wondering if Opendoor has a place alongside their Fidelity mutual funds or Fidelity ETFs. The Fidelity mobile app and Fidelity trading platform make it easy to buy, but the decision is hard. It requires a deep belief in this turnaround story. The entire bear case rests on one undeniable headwind: the macroeconomic environment. The iBuying model is acutely sensitive to interest rates. Even with the Federal Reserve initiating a small 25 basis point cut back in September, 30-year mortgage rates are still hovering over 6.3%. This creates the lock-in effect. People who have a 3% mortgage are not selling their homes unless they absolutely have to. This starves Opendoor of its lifeblood, inventory. If they don't sell, Opendoor can't buy. If they can't buy, they can't sell. This is the central tension of the stock. Opendoor is betting everything on its internal AI pricing models and a 2026 break-even goal. But the Federal Reserve holds all the cards. Comment below with what you think is the bigger factor for Opendoor's survival: their internal AI strategy or the Federal Reserve's next interest rate decision. It's important to remember what Opendoor actually does, and just as importantly, what its competitors did. The company is an iBuyer. They use algorithms to make all-cash offers on homes, usually within 24 hours. If the seller accepts, Opendoor buys the home, performs light repairs, and then lists it back on the market, aiming to profit from the service fee, typically 5%, and any home price appreciation. It's a high-volume, capital-intensive, low-margin business. It's also a business that has destroyed its competition. Zillow Offers famously flamed out, shutting down its iBuying arm in 2021 after massive losses. Redfin now also threw in the towel. Opendoor is by a massive margin the last dominant player standing. This is a critical part of the bull case. While the market is terrible, they have it almost entirely to themselves. They are not in a bidding war with Zillow for acquisitions. This gives them a significant advantage if, and it's a big if, the market ever normalizes. For investors who believe in this last man standing thesis, the options for online investing are everywhere. You could be looking at SoFi, which through SoFi Invest offers both SoFi Active Investing and a SoFi Robo-Advisor. Maybe you're already using the Robinhood platform for Robinhood investments, or even exploring Robinhood Crypto and Robinhood Cash Management while you wait for an entry point. More sophisticated traders, the ones who are perhaps shorting the stock or building complex options positions, are likely using a platform like Interactive Brokers. The Interactive Brokers trading platform is built for professionals who understand the risks and want low Interactive Brokers fees for high-volume trading. But for many, this isn't about active trading. It's about finding the right investing sites to build a long-term position, whether that's through a Fidelity brokerage account or another online investing service. Looking forward, the scenarios are stark. The bull case is that Friday's 23% intraday reversal was the moment of capitulation. It was the market finally looking past the Q3 flush of old inventory and buying into the 2026 break-even plan. In this scenario, the new AI-powered acquisition ramp-up in Q4 is successful. The company buys inventory at the right price, the macro environment cooperates, and the Fed is forced to cut rates more aggressively in 2026 to avoid a deeper recession, which unfreezes the housing market. As the last major iBuyer, Opendoor captures enormous market share and scales its way to profitability, and the stock re-rates to a much higher multiple. The bear case is just as compelling. The macro environment wins. High rates persist, the lock-in effect becomes permanent, and housing transaction volume stays at historic lows. Opendoor's Q4 acquisition ramp-up is a disastrous mistake, a repeat of 2022, where they bought homes at the peak only to see prices fall. The $90 million quarterly net loss continues to burn through their cash. The 2.2% contribution margin proves to be structural,